Good morning, ladies and gentlemen, and thank you for joining me for this session of the review of the Federal Reserve Bank of the United States FOMC meeting, which held on Tuesday, June 9th, and yesterday, Wednesday, June 10th. Oh, by the way, this is your morning market update with your professor. So I'm just going to jump right into it and just going to sort of a few caveats before we go down the line. I'm going to limit this conversation to this FOMC meeting. So this is just not a broad conversation on my views or market views or consensus views. We're just going to focus exclusively on this memo, the minutes of this memo. It's about 4 pages long. The first is the brief, the minutes, or sort of the summary. The second page outlines all the actions that the FOMC has agreed to undertake. The third page includes their estimates, essentially their projections, macroeconomic projections going out 3-4 years. And of course, the last page is the chart. Now, I've shared a number of these already on the blog, so I hope you've had a chance to look through some of it. So I'm just not going to dive right into the numbers since you already had a chance to have a look at them. What I want to do is spend some time analyzing not just the memo itself or the outcome of the meeting, but more or less the sentiments or the body language of the Fed chairman, especially during the 1 hour long conference call that followed the FOMC meeting. Now, I do have to say, I will put out a disclaimer there that I've been a very harsh critic of the U.S. Fed for quite some time now, for very many years that I've followed and I've watched the Fed. Clearly, I'm on the conservative side when it comes I lean more towards the conservative side when it comes to monetary policy. I wouldn't call myself a full-on Austrian scholar, but I lean more towards the Austrian school of economics than towards the Keynes school of economics, which is more much more of a liberal view of monetary economics. So let's get right into it. I'm going to sort of read out 3 lines essentially that I highlighted on the cover note. It says, in light of this development, the committee decided to maintain the target range for the federal funds rate at 0 to 0.25%. The committee expects to maintain this target range until it is confident that the economy has weathered recent events and is on track to achieve its maximum employment and price stability goals. It goes on to say, in determining the timing and size of future adjustments to the stance of monetary policy, the committee will assess realized and expected economic conditions relative to its maximum employment objective and its systematic 2% inflation objective. The third part I want to cover says, to support the flow of credit to households and businesses over coming months, the Federal Reserve will increase its holdings of Treasury securities and agency residential and commercial mortgage-backed securities, at least at the current pace, to sustain smooth market functioning, thereby fostering effective transmission of monetary policy to broader financial conditions. It goes into more detail, but I think those were the 3 key highlights. Now, I've made my own notes behind here, which we will get to, but before that, I want to get through some other items. So it goes through some of the action points. What are the things that are actually going to be implemented as part of this FOMC meeting? Now, there's really nothing here that is new. As we all know, there are 2 main tools, or sort of the key main tool that the Fed has is essentially setting rates. It does this through open market operations, through the repo window. This is the way it's always operated, by using or working through primary dealers and using that as a transmission mechanism to communicate its monetary stance to the marketplace. Now, that has always been the way it worked until it didn't work anymore, i.e. during the 2008-9 financial crisis. And that was when they pulled out the second tool, which was essentially asset purchases, essentially bypassing the banks and the primary dealers and actually creating money or liquidity and going out right there into the marketplace to purchase treasuries and then mortgage-backed securities, which were added to it. And that sort of became a mainstay of the Fed's activity, actually really after 2008. Now, fast forward to 2020, not only are they purchasing mortgage-backed securities and treasuries, but added to that list are other assets like corporate bonds, even high-yield exchange-traded funds or high-yield ETFs. There are also several and different loan programs there where a vast range of collateral have been allowed to be used to securitize some of these loans or these loan programs that accompany the existing asset purchase. So we can see here that the Fed's got its hands full in terms of the ways that it's intervening in this market. Now, a third way, which I'll touch on later, which is even something a bit more novel, which is being considered, is something called yield curve control. And what does that mean? It means not just broadly targeting interest rates, but actually going into the yield curve and targeting specific interest rates along that yield curve as a way to reverse engineer the shape of the yield curve, essentially. So, and I'll get to that. It's a bit technical, but we'll get to that. So let's get back to the action items on the Fed list. So the key thing there is interest rates. That's at 0. I mean, 0 to 0.25, 0 to 0 to a quarter, which is, I mean, 6.5 a dozen. That's not going to go anywhere. There's really no room to go lower there. And they stated in their chart here that those rates they're not going anywhere any day soon. So you can see that in the bottom line here, Fed funds rate. If you look at your chart which I shared, you will see at the bottom, that number is at 0.1 going out, and then longer term it says 2.3, 2.5. I don't believe it. I think we're going to be at 0 to 0.25 for a while to come before we start to see any signs of inflation, if any. So that's that. Interest rates done. The next thing, obviously, is asset purchases. They've been purchasing assets at a massive rate. The first week of the crisis in March saw them purchasing as much as $75 billion in treasuries and mortgage-backed securities a day, $75 billion at the height of it. And then they tapered it down to something that seems more like $4 billion or so a day. Now, the Fed chairman reiterated in his comments that they're going to keep purchasing assets. And while he didn't come out and put out any specific numbers, I mean, I did my own research and crawled around the internet, and the numbers are something like $80 billion in U.S. treasuries a week and $40 billion in mortgage-backed securities a week. So they again reaffirmed that they're going to keep using asset purchases to sort of maintain fluidity in the treasury market and in the mortgage market, and obviously extended into now other markets. Now, what he didn't really talk about, listening to his press conference, was some of the other red lines, in his own words. Asked a few weeks ago, he says, we know, we've crossed quite a few red lines here. But he didn't go there. So, for instance, there was no mention of corporate bonds or high-yield bonds or ETFs or some of these other really exotic places that they've been to recently. It never came up in the Q&A. I was quite surprised that none of the journalists on the conference call, on the televised conference call, brought it up. So I'm not sure where they stand on that, and I think sort of that's where we're seeing quite a bit of problem in terms of an overflow of excess liquidity into equity markets. As a lot of these junk bonds or high yield issuers are going to market and basically have access to market, you're seeing a lot of that overflow into other risk assets like equity. So he didn't mention exactly where they stood on that, but when asked about financial markets and current exuberance, his response was pretty classic, and I'll get to it when I get to my summary here. So that's it. So we're done with this. I don't think that there's much else to see here. It's just sort of, again, the garden variety. He talked about repos. Essentially, they're going to keep working on keep repo operations functioning. There's a counterparty limit of about 30 billion per day. Again, these are all just sort of like really arcane minutiae that you don't really care about unless you're a market participant or unless you're a primary dealer. For the average person, I mean, things like this really don't surface. So again, as far as actions go, one, interest rates are going to stay at 0 to 0.25. They're not going anywhere. Asset purchases are going to continue, especially in the U.S. Treasury and MBS, mortgage-backed security sectors. 80 billion USD a week, 40 billion MBS a week. That's sort of the street number. I haven't verified that officially. And then as far as all the other loan programs, ad hoc loan programs, none of that has been mentioned in this Fed memo, but I presume sort of they have their own cheat sheet somewhere. So that's that. Now, let's move on to the actual economic number, sort of the actual data or the projections. And this is where I think it gets quite interesting. Now, I have to say I'm looking at these numbers, and I'm trying to sort of match them up against the body language of Chairman Powell while he was speaking. One thing I would say is that, again, I've been historically a critic of the Fed, of sort of their monetary philosophy or doctrine. But I think listening to him today, I saw a lot of humility. He really looked like a man whose job I didn't want right now. He looked like he truly had the weight of the world on his shoulders, and you couldn't not empathize or sympathize with him. And so, I'm having to revise my own sentiment, so to speak, and that may influence sort of the way I'm interpreting these numbers, or sort of, in fact, the way I'm communicating this particular video to you, the audience. So with that, let's go into the numbers here. They're projecting 2020. We all know it's going to be really bad, COVID, but they're projecting a drop of 6.5% in real GDP, right? So that's from 21.4 trillion last year actual. It's projected that the GDP output is going to contract by about 6.5 trillion, 6.5% this year. Which brings us to somewhere, I believe, around 20 trillion or so. And then in 2021, they're projecting 5% from there. So again, compounded, they're projecting a 5% annual growth from 2020 to 2021. And then in 2022, they're projecting 3.5 growth. And then beyond 2022, they're looking at 1.8 longer run. So I would imagine sort of like the growth starts to tail off from there. Now, obviously, this is the base case, right? So, if we look at these numbers again, there's sort of like a central tendency which has a range of numbers, sort of with the base case sitting in the middle. And then off to the right is even sort of a wider range, which goes as low as 10% shock to GDP in the current year. So it's these numbers, they're literally all over not all over the board, but it leaves a lot of room for interpretation. Now, being the thinking man that I hope I am, I take their base estimates with a grain of salt. But I agree with 2020 that 6.5 percent contraction sounds like a reasonable number. I know a lot of people are calling for a 10% contraction, but it's probably going to be somewhere between that and 10%. I don't see an upside surprise there, so I'm going to leave it at somewhere between 6.5% and a 10% output shock. 2021, Chairman Powell is calling for a 5% return to growth from the 2020 numbers. I think that's fairly optimistic. I think we're going to see a pop. Naturally, we're going to see a pop, but I think probably a pop back to maybe 3%, 4%. And why do I say that? It's just sort of the deficit overhang is just absolutely mind blowing, and also the extent of the damage or the COVID damage. And by the way, there was a deflationary damage or sort of deflationary concerns in the background. Even before COVID, we had started to sort of see the economy start to track down. There's the issue of credit and sort of debt or levels of debt, both at the public, at the private levels. All those things are going to have to sort of work themselves out somehow through this cycle. So I don't think we're going to see any really massive pop at the end of this. So 3%, 4%, 3 to 5% seems like a reasonable number. Now, where I think this gets really tricky is sort of after 2002, after 2001, once we start getting into 2002. Now, here they're projecting 3.5% growth in 2002. Not impossible, but a lot of things would need to happen in 2001. A lot of magic would need to occur. Unemployment would need to come down significantly. Aggregate demand would need to return significantly for us to sort of even see anything close to a sustained number such as 3.5 in 2002. I would be more skeptical and pull back their longer run estimate of 1.8 into 2002. And I think you can expect to see that number stay at that level, sort of say between 1.5 and 1.8, or sort of between 1.5 and 2, going out into the foreseeable future, because like I said again, the deficits, current and building deficits, are going to be a major cause of concern. So that's it for the data. And of course, the next is we go to the charts, right? These are just sort of like visual representations of what's already in the data. So I'll leave that here for now. Now, what I want to do is just do a quick summary. We're currently at the, how much time do we have? So we've gone about 18 minutes. What I want to do is to take 5 to 10 minutes. And so we sort of make this about a half an hour, 30-minute video. What I want to do is take about 10 minutes or so, 7 to 10 minutes, and go through my own personal notes and observations. Now, while the Fed Chair Powell was speaking, I was making notes, copious notes, and sort of numbered them down with some of my own remarks on the side of the notes. The first thing I noted is that basically he was pretty adamant about the fact that the Fed is going to do whatever it can to sort of keep things in order, or at least sort of to sustain the recovery. Second, it said, there's only so much we can do. In essence, it's saying that the Fed's job is not to create spending or to sort of to stoke demand. Its job is to ensure that the financial plumbing works. And it does that by ensuring that markets work and that there's liquidity in the system. And so there was a lot of jawboning here, and I think he was indirectly speaking to Congress that they probably need to do more here and they need to step up. So that's going to be another interesting battle. We're going to see sort of what happens when Congress comes back from session over the summer, and how much appetite the conservatives would have for additional stimulus at this point, having already passed almost $3 trillion worth of stimulus year to date. The third point I made was, will they explore yield curve targeting? I think there was a specific question from the audience. Are you looking at yield curve control or yield cap? And he sort of sidestepped that. He didn't say yes or no. He basically said, listen, we're watching the situation. We're receiving data every day, and these things keep changing. And this is just such an uncertain type of a crisis that it's hard to make any specific prediction. So I think he left the door slightly open for more aggressive action or sort of more aggressive doctrine without really coming out to say, listen, we're going to go negative or on interest rates, or we're going to start picking spots on the yield curve. So that's there. Now, regarding financial assets and the general sense of exuberance in current markets, one of the journalists, I believe, from the Financial Times brought up the fact that the market seems to be completely losing it with day traders essentially gambling on the corpses of bankrupt companies and just sort of ridiculous excessive valuations. He says, listen, that's not my problem. In very, very, very simple things. That's not my problem. My problem is to ensure that markets work and that there's liquidity and that the markets function. And he says it is not my job to price risk, and that the markets function is essentially to price risk and to value assets properly, and that wherever there's an imbalance in sort of risk pricing, that the market does its job and corrects these valuations. So I think it was sort of a double-edged answer. So while the journalist might have been looking for him to sort of say, listen, I'm going to come in and jawbone the market and talk down the speculation, he said, I'm not going to do that. But he also said at the same time, if things get ahead of themselves, I'm just going to let the markets do what they should do, which is correct its assets or sort of reprice its assets based on the perceived risk. So I give him credit there. He didn't really, he dodged the question there, but basically what he was saying is that, listen, I'm just not going to go there, and I'm going to let the markets do what the markets do. The next thing was why we aren't targeting asset prices. He says, listen, we're not going to watch, we don't have our eyes on the indices or on the Dow or the S&P or any of the stuff or NASDAQ. Our key mandate is targeting in inflation and labor markets. And this is our key, essentially prices, essentially price stability and full employment or maximum employment. And this is our full mandate, and this is really all we're concerned about. So that our eyes are going to, or their eyes are going to keep focused on inflation. Again, he says the inflation target here is 2%. Now, he was very quick to stress, listen, for all those running around screaming about inflation and how all this printing of money and it's going to sort of create inflation and blah, blah, blah. He says, listen, as hard as we tried between 2009 and 2019, during the longest bull market on record, he says, listen, we did not even, as hard as we tried, we got as far as 1.7% before the whole thing came down. So he says, listen, it's not that easy to create inflation in this environment, and that the overwhelming force is deflation. Says this is a fight of our lives. It's not been easy to create inflation. He says, listen, we'll take inflation if it means we can return the market to full employment. We'll welcome inflation if it brings back employment. But right now, says we're not seeing it. We just don't see inflation anywhere. So he maintains his stance there that they keep targeting 2% as the inflation target, and will do whatever they have to do to get to that 2% number. And also, of course, with that 2% number is going to come, hopefully, a return of full employment. So that's sort of where he ended. In summary, he says, listen, we're focused on the real economy goals, and our job is not to be the watchdog for the markets. There are regulatory agencies that handle that, and we're just not going to go there. So that's that. So I made a note on asset purchases. We already talked about that. Treasuries, again, this is not explicit, as in sort of you're not going to find any of that on here. They haven't come out and said, listen, we're going to buy 100 billion worth of treasuries. But I did some of my own research, and you can go out there, and there are any number of estimates. But the average or the consensus or the rumor, the whisper, seems to be that that number is about 80 billion a week in treasuries. They're looking to purchase, and 40 billion a week in mortgage-backed securities to provide continued liquidity and stability in the market. Now he said that basically they're going to remain open to movements in the market, so they're being given that optionality to adjust, just like they've done over the last 2-3 months, if one is to be fair. At the height of the crisis, they were buying $75 billion worth of these bonds a day, and then now they're down to about $4 billion a day or so. So accordingly, he says they're going to keep watching the markets, and then we'll have to adjust the purchase program depending on how quickly the numbers turn and in what direction they do. So that's about it. I made a note on interest rates. We already talked about that. It's basically on the floor for the foreseeable future, 0 to 0.25%. I don't think that's going to change any day, anytime soon. He says no negative rates and no yield curve control for now. Specifically, he says, obviously targeting interest rates along the yield curve is an option, which is, again, yield curve control. We talked about it yesterday, which is the Fed's ability to essentially to cap rates at certain points on the yield curve, more specifically at the short end of the curve. So sort of anywhere from the 90-day bills up to the 5-year notes, they can cap that and sort of leave the 10-year notes and the 20-year notes to essentially to sort of to find its level. And in that way, you're able to sort of maintain an upwardly sloping yield curve and allow them to access financing, especially for the federal government, at the shorter end of the curve at suppressed interest rates. So that's about it. I think we're at 27 minutes. It's been a full and comprehensive session, I hope. And that's about it. If you have any questions, of course, I'm always available on the blog. There's a lot to chew on here. There's a lot, I could go on and on and on and on. I mean, it's just 4 pages, but we'll take care of that on the blog over the Q&A session. So once again, thank you for watching, and enjoy the rest of the day, and have a productive weekend for us, because we're going into the weekend here. Today, initial claims. So initial claims out in a few hours, in a couple of hours or so. So we're going to look for confirmation for the kind of main numbers we got from DLS, and if initial claims actually dip beyond sort of 1 point, I think they came in at 1.7 last week. If we see a massive dip in initial claims, then we could actually say, listen, looks like we've turned the corner here. But until then, let's keep watching. Thanks, guys. Take care. Bye-bye.